One fund, on point for today, the expert to talk about it. This is the ETF of the week. Yes, welcome to the ETF of the week, where we get the latest take from Todd Rosenbluth, the head of research at VettaFi. And if you go to VettaFi.com, you'll find all the tools you need to be a savvier, smarter ETF investor and to get more details on the new, newsworthy, trending, and timely ETFs that we talk about here. Todd Rosenbluth, great to chat with you again.
It's great to be back, Chuck.
Your ETF of the week is
the Fidelity Corporate Bond ETF, FCOR.
FCOR, the Fidelity Corporate Bond ETF. We've talked about a lot of different types of bonds over the recent weeks because, of course, we're in a rate change environment. Why corporate bonds, and specifically this fund right now?
Well, last week we talked about an aggregate bond active ETF. That was a T. Rowe Price ETF for folks that didn't catch that segment. This is an actively managed fixed income ETF from Fidelity, but it's targeted towards the corporate bond space. We're finding more advisors, more investors want to build their own broadly diversified fixed income exposure. And so this ETF, FCOR from Fidelity, can give you that active management capabilities targeted towards the corporate bond space, where there's perhaps the greatest opportunity to sort through that universe to find the companies, the issuers with the strongest reward without taking on that much risk. And this fund just passed its 10-year anniversary. So there's certainly a strong track record, a long track record for folks to dive into, which we can spend some time on.
Well, let's spend a little bit of time on that, but also without saying, hey, go listen to last week when we were talking about active management, is you were very specific last week that you didn't just want active management, but that the fund we were looking at was particularly appropriate if you wanted to add active management because it was low cost, but quantitative, so it had this very rigid approach. Fidelity tends to be a little more free-flowing, a little more on the manager side of things. So help us understand that track record and whether it shows us why we really want to be active and this kind of active in corporate bonds.
Right. So the track record for FCOR, the Fidelity Corporate Bond ETF, is relatively strong. It's outperformed its Morningstar category over that 10-year time period. If you look at individual calendar years, it's outperforming more often than not. Now, what it does is focus on, as you would imagine, on corporate bonds, primarily investment-grade corporate bonds, and primarily within that, BBB rated bonds. So that's the lowest rung of investment-grade credit, where you can find companies that have strong fundamentals that are likely to stay investment grade. You get rewarded if companies stay investment grade as opposed to getting downgraded. It tends to favor more of the financial institutions, at least that's what it's been doing in 2024. So you do have that fundamental bottom-up approach to sorting through the credit universe with this active ETF, as opposed to a quantitative approach. You're right. The T. Rowe Price fund that we highlighted last time was a low-cost approach. There's a slightly higher fee for the active management capabilities that Fidelity is offering, but folks are quite familiar with Fidelity from an active standpoint. From the mutual fund world, this is an ETF that has a 10-year track record. There aren't a lot of active fixed income ETFs with a 10-year track record, so it's worth celebrating and taking a closer look at this fund.
In terms of expectations, as you pointed out, corporate bonds, but just above the level of high yield or junk bonds. In other words, one tranche above that is the core focus here. What does that do in terms of expectations? You know, you had the aggregate bond fund last week. How many different bond funds are we going to want to do? And are we doing it because the asset classes perform differently? Or are we doing it because, well, we're a little further out the risk spectrum, so we'd expect a little bit better returns here?
Well, fixed income ETFs are an increasingly larger slice of the ETF pie in terms of flows. So I want to sprinkle in more fixed income strategies. Actively managed fixed income ETFs are punching above their weight, and they're more interesting to talk about than necessarily a low-cost index-based category. There are index-based products that are tied to corporate bonds from iShares, from Vanguard, from State Street, among others. And you should certainly compare this Fidelity active fund and how it's performing relative to those lower cost index-based products. If you're building a portfolio and you have a low cost aggregate bond strategy, this could be a way to overweight that exposure to corporate bonds. Corporates are roughly 25-30% of the ag. Most of it is tied to government bonds, treasuries, and agencies and mortgages, where corporates is a narrower slice. So you could overweight that, or you could build combining a couple of active strategies and leaning on somebody and some manager like the Fidelity Corporate Bond ETF to tilt or to rebuild that portfolio from an investment grade standpoint.
Last week, part of our discussion centered around, do you want to be mixing active and passive strategies in a certain space? So again, if somebody's got their corporates and they've got them covered with a passive fund, split that position in corporates between active and passive, or, trend, you prefer the active, so go active when you get a chance. How do these things play together?
Yeah, so if you're a fan of active management and you've been using active, broadly diversified funds, this might be a good one for you to take a closer look at. If you've leaned on active mutual funds historically to get fixed income exposure, you're going to get that same benefit of active security selection that you'd get, but with the benefits of an ETF, the efficiency, the tradability, the cost structure that you'd find with in a fixed income ETF. If you own a dedicated slice to corporate bonds, decide whether or not this active approach might make more sense for you. You probably don't want to have two dedicated corporate bond strategies. This fund is certainly going to be different than what you'd find in an index-based world. It's taking advantage of the active capabilities and leaning in on the fundamental research. But there's lots of use cases, and we think the Fidelity Corporate Bond ETF, now 10 years old, is worth a close look.
And this is clearly an allocation choice. This is not so much about timing. You're basically saying if you're going to diversify your bonds, you're going to own some corporates, find a way to do it and do it well. How much of a portfolio do you let this be? Because this is, again, not something that if the rate environment changes a lot, you're going to be getting out of it, are you?
So, right. I think this is a strategic exposure. Obviously, folks that have more knowledge about credit spreads and comfort in the timing should certainly take a closer look. I don't have that level of expertise coming into this conversation. Maybe the audience members do, and they're looking for a corporate bond ETF to overweight and then to move off. Corporate bonds are roughly 30% of the investment grade universe, if I use the ag as my reference point. So do you want to have more exposure to that because you're going to get more reward in this current environment? They're a little bit more credit sensitive as opposed to rate sensitive. That's up to folks to be able to decide. But this is one of those good active fixed income ETFs to take a closer look at.
It's FCOR, FCOR, the Fidelity Corporate Bond ETF, the ETF of the week from Todd Rosenbluth at VettaFi. Todd, great stuff. Thanks so much. We'll talk to you again next week.
I'll see you soon, Chuck.
The ETF of the week is a joint production of VettaFi and Moneylife with Chuck Jaffe. And I am Chuck Jaffe. And I'd love it if you check out my hour-long weekday podcast by going to moneylifeshow.com or by searching wherever you find your favorite podcasts. And if you're searching for more information and better information on your favorite ETFs, look no further than VettaFi.com. They have all the tools you need there to help yourself and to get a better understanding of all the funds you're investing in. They're on X or Twitter at Vetta_Fi. Todd Rosenbluth, their head of research, my guest, he's there too. He is at Todd Rosenbluth. The ETF of the week is here for you every Thursday. Subscribe on your favorite podcast app to make sure you do not miss an episode. And we'll be back with another exciting ETF for you to consider for your portfolio next week. Until then, happy investing, everybody.